This is the Savvy Investor radio show and podcast with Mike Kinnett and Ryan Herbert of ProStatus Financial, now celebrating 20 years helping families build successful retirements and lasting family legacies. Mike is a financial planner and estate planning attorney with a master's degree in tax and 4-time Amazon best-selling author. Ryan is a 5-star Wealth Management Award winner and top-ranked financial advisor by Forbes. Now, the Savvy Investor radio show and podcast.
Let's talk about the quote unquote Trump tax cuts. Those are scheduled to expire at the end of 2025, at the end of next year. If Congress doesn't do anything, they're going to expire. So they have to act to keep those where they are right now. And this kind of blends into what I want to talk about as well. Change is coming to 2025. But let's first address those tax cuts. If they don't do anything, taxes are automatically going to go up.
Absolutely. So they go up across the board. Corporate America taxes go up for the small business people like myself, right? Because we lose some of those tax write-offs there, some of the tax brackets there. For the individual, taxes go up across the board. All the tax brackets go back to where they were in 2017. So, most people are going to find more of their money in a higher tax bracket, not just marginally more, but significantly more. So it's a pretty big tax step up for most people. We're seeing 25% increase in your taxes for some people. I think the biggest thing that people aren't paying attention to, and I know when I say this out loud, it's kind of interesting what rich means to people, right? Mm-hmm. Am I rich or am I not rich? And most people that I meet don't think they're rich, but by definition, they are, right? So if you have $1 million of assets, you're deemed rich. Now, I recognize you don't feel rich and you don't act rich, but the government thinks you're rich, and half your neighbors think you're rich. And here's the reality. If you're roughly 60, 65 years old, and between your house and life insurance and investments, you're worth $3 million roughly, believe it or not, effective 2026, so starting at January 1st, 2026, you have an estate tax problem. And what I mean by that is right now, you could pass roughly $13.5 million. It's a little bit more than that, but you could pass roughly $13.5 million. You can give it away while you're alive, or you can pass when you're dead. But if you do that before 2026, the first $13.5 million of your estate goes estate tax free. Now, above that, it's draconian, right? So they're going to take 30, 40, 50% right off the top past that. And Maryland, God bless Maryland. Maryland likes to tax the right for you to give your money away, but Maryland also, for some people, likes to tax the right to get money that was given away. So not only will Maryland charge some people, and about a half a dozen states do this, there's an estate tax, which is the right to give your money to somebody at death, but there's also an inheritance tax. For some people, the right to inherit money is taxed as well. So, you get hit by the state, you get hit by the federal, you get hit by the state a second time, and don't forget there's income taxes on top of all that for some of this money that's coming in. So it's tax. And in 2026, that tax rate goes from 13.5 plus down to about somewhere between 6 and 7 million, based upon inflation rates, right? So all of a sudden, if you're $3 million if you have $3 million today, 10 years from now, that $3 million is worth 6. 10 years later, it's worth 12. Well, at 6 million, you have an estate tax issue. At 12, you're getting crushed in estate taxes. And you have basically until the end of 25 to take advantage, because you could protect 13.6 million today. If you wait to January 2026, you're hosed. And the tax, 40%. So imagine if you're worth that 20 million that I threw out there. If you're worth 20 million and 15 million of it's taxed at 40%, you gave up $6 million because you failed to plan. That's insane. And again, if you're working with an advisor, or you have an estate plan and you're working with an attorney, or if you have a CPA or some sort of person talking about taxes to you, and they're not discussing this with you, it's like, what the F is going on? You need to be paying attention to these tax rates right now. And quite frankly, I mean, if you're 40, 50 years old, if you're your age, or maybe even into your 60s, and your parents are still alive at 75, 80 years old, you have an incredible opportunity for the assets that you personally own today to be able to get a huge step up to take advantage of a few tax rules. Because you know what? One of the things they're talking about doing in 2026 is getting rid of the step up in basis for inherited assets. We'll take advantage of it now. Get those rules taken advantage today. And it all starts by picking up the phone and giving us a call at 866-597-1040, 866-597-1040. Sit down with Ryan and myself and our team, and we'll show you how to create income streams you'll never outlive. We'll talk to you about the fees you're paying, the risk you're taking, long-term care estate planning, and folks, taxes. I mean, I can't stress how important taxes are for people, and they're ignoring it. They don't get the advice from their current advisory team. It's not my job, man. They don't get it from their CPA. They're historians that put numbers on a page based on last year. The attorneys are not proactive, not looking forward either. They're afraid to reach out and talk to you because all of a sudden now I'm advertising and marketing chasing a client. They don't like to do that. They feel it's beneath them. I don't know why they're not taking advantage of this. There is a huge opportunity for you, our listener, for you, the investor, to protect yourself from the increases in taxes from an estate planning point of view, from increasing taxes from an IRMA and Roth conversion and tax efficiency point of view, from capital gains. There's so many things you need to do over the next 14 months to make sure that you're prepared for the worst case scenario, which is entirely possible that's going to happen effective January 1st. And it all starts by picking up the phone, 866-597-1040, 866-597-1040.
Make sure to take advantage of that right now. 866-597-1040. As Mike said, you got about 14 months left to take advantage of probably the most, the lowest tax environment in our generation. 866-597-1040 and online at thesavvyinvestorradio.com. Again, that's thesavvyinvestorradio.com. Front page tax analysis button, and that'll get you a quick 15-minute phone conversation with Mike, with Ryan, with the team at ProStatus and here on the Savvy Investor Radio. Another change, I want to get to this, that's coming up in 2025 regarding our 401ks is the catch-up contributions for people 60 to 63, Mike. You talked about what we can do now in these 24 months to help reduce taxes in the future if they don't change the tax codes coming up at the end of 2025. For those that are playing catch up, you've mentioned this before, and I want to dig into this a little bit, that it's not that we saved. It's not that we did a bad job of saving, but
we're saving in the wrong spot.
Saved in the wrong spot. So what do we do? Do we save? Do we catch up in our 401ks, or is there a better place to catch up?
Well, and so a better place is all kind of relative, right? If you Google what are rich people doing, right? And even though we might not think we're rich, if you Google what rich people are doing, rich people understand the benefits of arbitrage, right? When Elon Musk bought Twitter, he did not sell $40 billion of Tesla stock. He borrowed money against it. Well, the problem is you can't borrow money in a 401k. You can't borrow money in a Roth. They keep changing the Roth rules on us. So if you want to be tax efficient, if you want to pay attention to the rules, if you want to understand the best place to put your money going forward, it can't all go into a traditional tax-free, tax-deferred account. You have to think outside the lines. You have to do what the Phil Knights are doing in the world. So you have to take advantage of the rules out there and find alternative places where you can grow your money at reasonable rates of return, and you can get it out tax-free for you. You get out tax-free for your kids. And if you do it correctly, you get it out tax-free for your grandkids. So you can do 3 generations of tax planning just by following the rules. The problem is that nobody wants to talk about tax planning because it's not my job. So absolutely, there's some great rules. Instead of it being, $7,000 for catch up, if you're 60 to 63, you can go to $10,000. I mean, so it's a pretty big bump. But if you're already getting 100% of your match and you're not getting additional tax write-offs for your contributions, or if you're putting money into a Roth 401k, maybe it's time to sit down with a team like Ryan and myself and have us show you how to create additional. Everybody understands the concept of diversifying your stock market accounts, right? So all your money's not exposed to, you don't buy nothing but Tesla or nothing but Northrop Grumman or nothing but the S&P 500. You diversify your investments if you're smart, right? We all know that. Don't put all your eggs in one basket. Some guy won a Nobel Prize for saying, don't put all your eggs in one basket, right? I keep recommending my grandfather. He told me very young, never fry bacon naked. He just doesn't make the cut. I don't know why. I think he deserves a Nobel Prize for that as well. But if you understand the concept of diversifying your investments along non-correlated asset classes to reduce your risk and increase your overall rate of returns, how come it doesn't make just as much sense to diversify your tax-free buckets of money? And that's what you should be thinking about today. That's what you should be thinking about tomorrow. And quite frankly, that's what you should be thinking about for the next 13 months, not 14 months, because by the time we get to December of 2025, it's too late to fix these problems. You're over. You're stuck with whatever you did. And then you're just holding your breath, hoping and praying that they don't hose us in 2026. And you know what? You asked me for my prognosticator, my crystal ball and all that type of stuff. I'm pretty sure we're going to get hosed in 2026 no matter what. No matter which way you cut it, they're going to hose us, all to make a political point of some sort, right? If Trump's elected, the Democrats will poo-poo everything so Trump can't get a win. And if Kamala wins, the Republicans will poo-poo stuff so she can't get a win. So either way, we as the consumer, we as American, we as middle America, we as the taxpayer, we are getting hosed, which is why you have to take advantage of the rules today. 866-597-1040, 866-597-1040.
And online at thesavvyinvestorradio.com. Again, that's thesavvyinvestorradio.com. If you've saved $500,000 or more for retirement, congratulations. Now is your time. You've heard Mike talk about what's going on right now, and you have a limited amount of time, about a year left, to take advantage of the lowest tax rates in our generation. You can do that today. You can start making a dent on that right now at thesavvyinvestorradio.com. Click on the tax analysis button. That'll get you a quick 15-minute phone conversation with Mike and the team at ProStatus, and of course here on the Savvy Investor Radio. Or if you want to go old school and you want to call, you can do that right now. We've got teammates standing by right now to take your call. 866-597-1040, 866-597-1040. But Mike, you were wrong on one thing. There's one guy who cares, and his name is #TaxMaster Mike.
#TaxMaster.
Here, write that down. #TaxMaster Mike. Mike Kinnett, of course, because in your book, which I've got right here, Nothing is Certain But Death and Taxes. I'm gonna flip over to page 15. You've written here, how can a person provide investment advice without actually understanding the tax implications on that advice? And if you call today, if you set up an appointment with Mike and the team, they're going to get you a complimentary copy of that. If you want to read it right now, you can go on Amazon and get that for you. But we're running out of time, Mike. Thanks again for your time, for your passion, for helping us each and every week here on the Savvy Investor Radio, the podcast, the YouTube page, and all that good stuff. Like, subscribe, check it all out, and follow Mike and the team and get some great retirement advice. Mike, as always, appreciate you. Love you, man. But as always, you get the final word.
This is Mike Kinnett. Thank you for listening to Savvy Investor Radio. We will see you, the Savvy Investor, next week.
Advisory services offered through ProStatus Financial Advisors Group, a registered investment advisor. Insurance licensed in Maryland. ProStatus Financial Advisors Group, LLC is not licensed in all 50 states. To find out if ProStatus Financial Advisors Group is licensed in your state, please call 410-863-1040. ProStatus Group, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through representatives of ProStatus Financial Advisors Group.